Hi, Professor Rex here. In this week's video, I'm going to focus on the simple tech stock portfolio my accounting students and I started in April of 2024 as outlined in red. It's a real-world investment portfolio where I make additional investments on the first trading day of each week and so far has an annualized return of 33.92%. And later in the video, I'll talk about some new investment research that sheds some light on an investment strategy that has significantly outperformed the market and is somewhat related to tech stock investing. And I'll talk about the huge breakthrough in artificial intelligence that happened last week. In next week's video, we'll talk in depth about our dividend stock portfolios that my accounting students and I started back in 2021 and 2023 as outlined in yellow. Like our tech stock portfolio, they are real-world investment portfolios where I make additional investments on the first trading day of each week. So in effect, they are accumulation portfolios mimicking someone in their working years who is consistently adding to their investment portfolios. And last week's video was about these two dividend portfolios, if you're curious to watch that. As a reminder, the portfolios on the right side in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action would probably be boring videos. So you can go online to read more about them if you like less frequent trading, and the website is beatthestockmarket.com. Before we look at the huge artificial intelligence news that has Wall Street up in arms last week, let's talk about the trading calendar. Since January has ended, let's look at the Stock Trader Almanac's January fact, also known as goes January, so goes the year. Basically meaning if the market is up in January, it's good news for the rest of the year and vice versa. According to the Stock Traders Almanac and the Center for Financial Research Analysis, the old adage shows that since World War II, if the S&P 500 rose in price during the first month of the year, the market has or was higher 86% of the time for the full year versus 71% average for all years, and posted an average increase of 16.2% versus 9.2% for all years. However, a negative January resulted in a 1.7% average decline along with a 48% frequency of advance. So much worse if January was bad, which we'll talk about in just a second. And better yet, a January gain in year one of the 4-year presidential cycle, which is what this year is, saw the S&P 500 jump an average of 18.3% in price and post a gain 91% of the time. Conversely, a decline in January of year one saw the market slip 1.9% and fall in price 2 out of every 3 years, so 67%. But remember, past performance is no guarantee of future results. So was S&P 500 up or down for January of this year? It turns out the S&P 500 was up 2.7%. So if the January effect holds true again this year, this is good news for the rest of the year. And wouldn't that be nice if the S&P 500 was up 2.7% each and every month this year? So now let's talk about some market news. Last Monday, artificial intelligence had its Sputnik moment. On Monday, it was learned that DeepSeek, an open source AI player from China, has produced AI software that matches the performance of AI software from OpenAI, that would be ChatGPT. And this team and OpenAI is based in the United States. DeepSeek did it at a fraction of the cost to train its large language model, LLM, as compared to OpenAI. And it was done with a fraction of the required hardware, and in fact their hardware is definitely not cutting edge. And it was done in a much shorter time period, 2 years versus 10 years for OpenAI. And it was done with a much smaller team than OpenAI. And it was done with OpenAI, with open source software. That means anyone can verify, build upon, and implement these innovations. So what does this all mean to investors? Let's go to the next slide for that. So what's the fallout from DeepSeek? Morningstar had the best summary that I was able to find. They said, we believe the sell-off is related to better than expected performance of DeepSeek. DeepSeek is a Chinese AI large language model believed to be on par with some of the best models released by OpenAI, which developed ChatGPT and others, despite not having access to leading AI accelerators such as NVIDIA's best Hopper and Blackwell products. DeepSeek raises concerns that future LLMs will be developed with 1, fewer graphics cards from NVIDIA, which is obviously bad for NVIDIA, 2, lower capital expenditure from hyperscalers. This means lower expenses, which is a great thing for users of large-scale AI like Meta, Apple, Google, and Amazon. 3, there will perhaps be less of a need for massive energy build-out in the U.S. And last Monday, at least one utility company saw its stock fall over 20% as investors worried there would be less demand for electricity. Now, for the rest of us, less demand for electricity is good things because that means lower price in electricity. 4, DeepSeek may also lead to an even stronger set of U.S. sanctions on China that could weigh on the sector even further. In other words, regulation may be implemented saying that a lot of U.S. chip companies can sell even less to China, which obviously would hurt their demand and therefore their bottom line. 5, this might not be all bad for companies like NVIDIA, though. Some believe this less expensive AI will lead to more companies using AI in the long run, leading to an increase in demand for those chip companies like NVIDIA. But this whole situation is fluid and subject to change. Some question if DeepSeek actually used high-end NVIDIA chips rather than the much cheaper NVIDIA chips they reportedly used. So, I've seen several lists of mega cap companies that will be affected the most from this breakthrough in artificial intelligence. And the list that I agree with the most comes from the Center for Financial Research and Analysis, and you can see this list on the right side of the screen. Note that NVIDIA is the only one with negative implications. So all the stocks on the list are in at least one of our stock portfolios with the exception of Oracle. Because they use AI extensively, the companies on the list that are preceded with a plus sign are likely to benefit greatly if the cost of using AI falls dramatically, as seems to be the case with the DeepSeek development. So all the companies on this list should benefit, except for NVIDIA, which you'll notice has a negative sign at the bottom of the list. So the only company on the list of mega caps that might be hurt is NVIDIA. If new AI large language models can truly be trained on far less powerful graphics cards, then demand for NVIDIA's most expensive cards will likely fall, maybe by a significant amount. I'm holding NVIDIA for now in our stock portfolios. So before we talk about the 10 tech stocks we bought last Monday, let's see how the portfolio has performed so far and its best performers. The portfolio was started on April 29th of 2024, and each week we add funds to the portfolio and invest in 10 tech stocks. The rankings of the tech stocks changes weekly. Currently, the portfolio consists of 25 tech stocks. The average investment so far has been held for 129.8 days and has produced an annualized total return of 33.92% using Excel's rate function. If we'd instead invested our weekly investment into the most actively traded diversified tech ETF, ticker symbol XLK, the annualized total return would only be 9.02%. XLK got hit pretty bad recently. But if we made investments on the same days in the S&P 500, we would have had a return of 20.65% instead of 33.92%. The best performing stocks in the portfolio so far, based on their initial investments, which for most are April of last year, are Shopify, 99.3%, ServiceNow, 41.4%, Broadcom, 38.1%, NVIDIA, 36.5%, and Apple at 36.2%. Now here's the usual disclaimer. This information is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So we did sell a stock last week. It was Marvell Technology. We had planned to sell it for a while, but didn't sell it until Monday. If we just sold it one day earlier, our gains would have been a lot higher. So because Marvell, which is a chip company, got hit last Monday due to DeepSeek. But we did end up selling Marvell for an average gain of 37.73% on 10 different purchases. The annualized return is 84.72%. Since we sold after the ex-dividend date, we will also be receiving a final dividend from the company a few days after the sale. Now let's talk about the tech stocks we bought at the beginning of last week. On this slide are our ratings for the top 15 tech stocks as of last Monday. I posted these rankings on our website, beatthestockmarket.com, last Monday, and then we purchased the top 10. Remember, we only buy 10 stocks, not 15. Now this list was created before the DeepSeek AI breakthrough, so it'll be interesting to see how much our list changes next week afterwards or after DeepSeek, if at all. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. More on what makes up our quality grade is on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. Our highest rated tech stocks last Monday were Adobe, NICE, Intuit, Lam Research, Motorola, Microsoft, Accenture, Taiwan Semiconductor, and ASML and Applied Materials. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now, one reason why tech companies have been outperforming the market might be because they tend to require little capital. As a simplified example, if you want to start a software company, you just need a computer and some software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, equipment, employees, etc. In other words, a lot of capital, which is very expensive to obtain and then maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital during the period of 1990 to 2024. And it's not even close. The research calculated capital intensity based on three formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. We find this research to be very intriguing and plan to do some digging to see which companies currently require little capital, are of high quality, are undervalued, and therefore look to be great potential investments. Now, since our last update 2 weeks ago about this, I was able to modify our research spreadsheet to calculate the three formulas that this strategy is based on. So now we have the capability to determine which companies are capital light and which companies are capital intensive. I'm hoping to have a list of potential investments when we do our next tech stock portfolio update, which should be in 2 weeks. I'm curious to see what sectors besides tech tend to require little capital. So stay tuned for that. So in the comments, let me know if you have any questions, and also let me know what portfolios or investment strategies you would like to see more of. And finally, here are the places you can reach me: YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll see you again next week with a list of dividend stocks we will have purchased on Monday. See ya.